We will go ahead and get started slowly with some announcements first while people still trickle in, and then we'll be happy to turn it over to our guest speaker for today. So formally, hello again on behalf of the National Glass Association. I'm Sarah Neiswanger, Director of Industry Engagement, and thank you for joining us for today's webinar. I'm joined by my colleague Lori Cowan, editor of Window and Door magazine, and our speaker Andrew Petrick, managing director and head of the industrial vertical at Brown, Gibbons and Lang. Before we begin, do take note of the NGA events coming up through the remainder of the year as they're seen on the screen, and we'll talk just a little bit more about those. The NGA Glass Conference is being held in Ann Arbor, which is just outside, in Ypsilanti, just outside Ann Arbor. Join us at the end of September for a terrific discussion, plus a special tour of nearby Guardian Glass. Registration opens August 5th, and you can visit our website or scan the QR code as you see it on screen for registration and schedule updates in the meantime. Glass Build America is taking place November 4th to 6th in Orlando, Florida. Build on innovation, find new opportunities, and strategize for the coming year. All of this you can do at Glass Build. We're excited to try some new things on the show floor this year, including an interactive zone that will feature some live demos. So do make a point to come join us at the end of this year for Glass Build. Exhibitor personnel, registration opens June 18th, and attendee sign-up will be available July 24th. And with that, Lori, I will pass it over to you to introduce our guest today.
Great. Thank you, Sarah. Good afternoon, and thank you for joining us this afternoon. I'm Lori Cowan, editor of Window and Door. I'm excited to introduce today's speaker, Andrew Petrick, Managing Director and Principal at Brown, Gibbons, Lang & Company. He's also part of the firm's executive committee and head of BGL's Industrials Vertical. Andrew has completed cross-border mergers and acquisitions transactions for family-owned, private equity-backed, and publicly traded businesses, serving a broad range of industrial end markets. Andrew primarily works with companies that design, manufacture, and market highly engineered products, including those that specialize in precision manufacturing, engineered materials, coatings, adhesives, sealants, and elastomers, residential and commercial building products, industrial automation, controls and technology, plastics and packaging, and value-added distribution. Andrew has written for Window and Door for a number of years, and I'm happy to turn the screen over to him for today's webinar. Andrew, take it away.
Thank you. Certainly, Sarah and Lori, we appreciate the opportunity to speak with you and others today, and for your help in helping us get this organized. So as indicated, my name is Andrew Petrick. I'm a managing director and principal at Brown, Gibbons, Lang. I've been with the firm for the last 30 years. Prior to that, I held positions in structured finance with KeyBank. Started out my career at E&Y, so I'm a CPA by training, non-practicing. As I said, moved over to Brown, Gibbons, Lang about 30 years ago. Where I find myself today, I sit on our executive committee, a partner of the firm, lead our overall industrials effort, and many of those areas that Sarah read through are areas that I have a team that cover. My primary area of focus from an execution standpoint is in the building product space, both residential and commercial. So again, we appreciate the opportunity to be here. We're long-term supporters of NGA, Glass Build, and Window and Door. We've had a great partnership with them. We look to continue to expand that partnership, and this webinar is just one way in which we're doing so. We'll talk a little bit further about some of our other involvement, specifically with within Window and Door magazine as well. So with that, I'd like to maybe spend a few minutes just talking about BGL, Brown, Gibbons, Lang, our firm. We're an independent firm. We're a true partnership, so we don't have any outside investors, any outside money. We're an entrepreneurial organization. We have about 120 plus employees. I mentioned to Sarah and Lori earlier today, we have 26 interns. This summer, we have 18 new analysts starting full-time in late July or early August. So we're a strong growing firm. a highly experienced advisory firm. We serve what we call the middle market. The way we define the middle market would be companies that have EBITDA of 10 to $50 million on an annual basis. We do some smaller transactions and some larger transactions, but our core area of focus is that 10 to 50 of EBITDA. We're a capital markets solutions provider, so we have a lot of different tools in our toolbox. Our primary product or our primary services, as you'll see it across the top box there, on the far left, mergers and acquisitions, and that would include both sell side and buy side, and that represents about 85% of the revenues of our firm. Capital markets, the box just to the right of that, is primarily debt and equity. So we'll work with companies that are primarily in growth mode to help them provide the right capital markets solutions to make sure that they have the capital to support their business, whether it's for an internal or an organic growth initiative or an acquisition, expanding a plant. We have a team of specialists in the capital markets that'll work with us as the sector team to develop the right solution to make sure that our clients have sufficient capital to support the growth of their businesses. Our clients are three primary categories. One would be founder and entrepreneur, represents a significant portion of our business. When I started here, 100% of our clients fell into that category. And if you were to take a cut of the business today, about 70% of our clients are founder-owned businesses or entrepreneurial-owned businesses. Another significant portion of our client base are private equity or portfolio companies owned by private equity firms. And then also we do a fair amount of public work, either taking companies private or working with them to divest a non-core division of the business. We do transact globally, and you'll see at the bottom of the page there our global reach. About 50% of the companies that we sell go to strategic buyers, about 50% go to private equity buyers. Very importantly, about 20% of our strategic buyers are foreign counterparties. So not only are we a US-based firm doing transactions throughout North America, we have global reach as well. Where about 60% of our transactions do involve foreign strategic buyers on an active basis in the processes. I'm in our Cleveland office. In addition to the Cleveland office, we have Chicago, Los Angeles, Boston, and New York, and we're in the process of opening a DC office as well. So that's a quick overview of the firm. And I do want to move into our specific commitment to the building products industry. As you'll see on this page, just some of the tombstones of transactions that we've completed and currently in the process of completing, and we'll have some additional tombstones later in the presentation materials. In the top right there, you'll see the BGL Insiders, and those are publications that we publish in-house. They're M&A oriented in the building products space. We're certainly not trying to compete with Wall Street type research. This is research really brought down specifically to the building products sector, what value drivers we're seeing in the marketplace from a macroeconomic standpoint, and then also getting into company-specific issues that drive value, both positive and negative. And we publish those at least twice a year. We can certainly get all of you on the distribution list, or you can go to our website and sign up for the publications. They are very highly anticipated research pieces that both private equity and strategic buyers frequently reference as they're evaluating their acquisition strategies. On the bottom left there, you'll see that we do attend a number of conferences and publish regularly. Window and Door has been very good to us as a partner. We're the sole content provider for Window and Door as it relates to any kind of M&A topics or activities. So we have the pleasure of producing content for Window and Door at least twice a year, and other publications as well. And then we regularly do attend conferences, IBS, obviously a natural one. I'm guessing a very high percentage of those that are on this webinar today also attend IBS, also attend Glass Build and IDA as well. So very active in the space outside or in addition to transaction activity. On the next page, you'll see some of the areas in which we work. So it is a relatively broad mandate. We've been at this for 20 plus years as a keen focus of our overall firm activities. We are one of the most active firms in the space, serving that 10 to 50 million of EBITDA. And it's been an important area for us. You'll see here that from a client standpoint, many of these are founder-owned, private equity-owned, divestitures of public companies, and we have a great mix of buyers as well. When we launch a transaction, we don't have any preconceived notions as to who exactly the buyer is going to be for a transaction. We do run focused and targeted processes, but we do allow multiple parties to participate in our process, trying to find that outlier valuation for our clients. Also, you'll note on this page the areas that we primarily work in the building product sector. Window and door is by far our largest subsector of building materials. We're also active in flooring, cabinetry, interior, exterior finishes, coatings, adhesives, and sealants across a good number of substrates. And then we also spent a fair amount of time in fencing and decking and backyard related pavers and things of that nature for outdoor living space. So again, it's a diverse practice from the types of products that companies that we work with, also from the materials that the companies are using to produce their products, and then also from an ownership standpoint as well. So that's the quick overview of the firm and how we spend our time in the areas of focus that we have in building product space, both residential and commercial. But let's turn and talk a little bit about some of the things that we've seen here over the last handful of years, and where we are, and ultimately leading up to a conversation as to where we are in the marketplace as it relates to deal activity, valuations, what types of businesses we think should be brought to market in this type of environment, and which type of businesses maybe should wait a bit until the time is right for them to launch a process. So on the next page here, you'll see U.S. residential housing starts going back to 2019 through year to date. Well, not year to date, but March 25th or March of 2025. You'll see here, and we're going to talk a little bit about the impacts of the ups and downs or gyrations, if you will, that we see in this chart. And going back to 2019 and 18 as well, we saw a very strong building products market. It was really gaining momentum as we turned the corner on 2019 and looked into 2020. Housing starts on a seasonally adjusted basis reached 1.6 million, which from a historical standpoint was a very good adjusted stat. And then along came COVID, and you'll see the precipitous decline there, relatively quick and relatively short-lived, but it did fall nearly 50% over, call it a 45 to 60-day time frame. Fortunately, that was a short-lived decline. And you'll see, as if you follow this chart, jumping to 1.5 million seasonally adjusted as we got into the summer months of 2020. And then we saw a bit of gyration, but a steady climb over that period of time, for the balance of 2020, all of 2022 or 21, and into 2022. As we navigated through COVID, there were obviously a lot of different dynamics going on in the marketplace. that impacted the housing starts and the production and sale of building products. And as we saw that market that was, again, strong in late 2019, gained strength in the mid or the early 2020s and into 2022, the market responded quite well to the COVID situation. The run lasted until late summer of 2022. And there were a number of things that led to the market declines that we experienced. We experienced it in our deal flow, frankly, late summer of 2022, kind of that late August, early September. Though there were cracks in the market earlier in the year, it really impacted our client base in that time frame, again, late summer of 2022. So let's talk about what led to the decline in 2022. Obviously, COVID impacted the market. It curtailed travel, led to staycations. There was the work from home dynamic, entertainment budgets, since people couldn't go out and dine and take vacations, they were investing in their home. And they were really spending that capital on improving their home environment, because that's where they were spending most of their time during this period. So what that did is it led to surging demand for building products. At the same time, with COVID and the supply chain disruption that came about because of shipping issues, because of not being able to be in person, it resulted in challenges to the supply chain environment. And that shortage, if you will, of materials led to inflation. And we saw it particularly in glass, steel, wood, and other primary building product materials. And once we saw those price increases occurring, we saw inflation set in and driving prices higher, not only in building products, it became broad-based within the overall economy. And housing incomes were just not able to keep up with that inflation. As we continued on through this period of time, also we saw interest rates start moving in kind of late first quarter, early second quarter of 2022. And as we got deeper into 22 in that late summer, early fall period of time, we saw very significant increases in the interest rates. If you could page one forward, please. So here's the graph on interest rates and also consumer price index laying over inflation over this period of time. But after a decade or more of relatively inexpensive mortgage rates and attractive mortgage structures for borrowers, interest rates moved meaningfully. You'll see that September of 2022, interest rates were nearly 7%. You'll see that a year later, they were still hovering at a higher level. They moved up to nearly 8%. And where they are today, approximately 7%. And these are the 30-year fixed. And so what we experienced over this period of time from COVID until where we saw the real significant decline in 2022 was, we refer to it as the perfect storm. COVID drove demand for building products. That led to supply chain disruption, coupled with the fact that COVID was impacting shipping and getting things from overseas into the US. Inflation set in, consumer confidence decreased, and then we saw the meteoric rise in interest rates. So all of those things came together to turn a white hot market into ice cold in a relatively short period of time. So if we advance to the next page, you'll see what some of the impact has been on existing home sales. And the significant slowdown in the sale of existing homes is a result of many homeowners feeling the locked-in effect. And what we mean by the locked-in effect is that with interest rates where they are and the inflation in building materials that resulted, it's very expensive to buy a new home. It's very expensive to buy an existing home. And in theory, more than in just in theory, that with interest rates where they are now, many homeowners that have very attractive priced mortgages in the, call it 2 to 4%, that locked in 30-year mortgages, just a couple few years ago. Now, if they go to trade up, get a larger home, or trade down to a smaller home, given the interest rates, their payments could actually be higher today for a smaller home than what they are currently experiencing by staying in place. So that has led to a bit of paralysis, if you will, in the sale of existing homes. And you'll see some of the trend lines here. Again, going back to September of 2020, about 6 months in on COVID, seasonally adjusted home sales, 6.6 million. And you'll see that bumped around, got down to as low as 6 in March of 2021, popped back up in January of 2022. And then as all of the elements that I mentioned in this perfect storm set in place, we saw a downslide here from 6.4. And now over the last, call it 12 or so months, it's been bumping around in that 4.46, 4.4 range. And that's where we are today. So that decrease from the peaks is down 20 or 25%. So a meaningful change in the marketplace, and also contributes to the fact that there's not that there's a disconnect between the supply of homes that are coming to market and the demand. So it's led to a dynamic where home values have stayed at very lofty prices, and they have to be very select or very prudent buyers to be entering the market in this current environment with interest rates where they are, and the affordability index as it relates to buying a new home or building a new home or buying an existing home. So so we see this impact here of the existing home market and new construction. Another important element, obviously, of the market is the repair and remodeling. And what we're seeing here is that the repair and remodeling market has shown very strong resilience. And this is frankly what's keeping the market afloat right now, is the fact that there are significant investments going into this locked-in effect homeowners that continue to invest in their homes. So they're replacing roofs, they're waterproofing, they're taking care of structural issues. They're also investing in cosmetics, painting, flooring, landscaping, kitchens, and they're also looking to expand their homes. So adding office spaces, 3 season rooms, adding a bathroom. So we see some very significant and very important dynamics as it relates to the repair and remodel industry. And again, it's quite positive that this market is staying as strong as it is, or we would see a meaningful impact on negative impact on building products in general. So where are we in the market today, and how are we viewing the market and potential investors in the marketplace? So it's certainly not all doom and gloom. There is, if you can advance one page here, please. There's certainly a long-term and compelling investment thesis for investing in building products, construction, repair and remodel. And just some of those factors is we continue to see accelerating household formations far exceeding the supply of the existing housing stock. Aging housing stock does need repairs and remodel. You can't afford to allow your roof to go while it's leaking because that will ultimately destroy the balance of the home. So there are some things that just have to be taken place or taken care of to preserve the value of homes. And that plays well into the fact that we do have this aging home stock that will require continued investment. There is significant pent-up demand. For 2 decades now, new construction has been far outstripped by the demand for new homes. The supply chain issues that I mentioned earlier that really took hold during COVID are largely alleviated. We're in an interest rate environment where I wouldn't say all, but most people don't expect interest rates to increase from where they are today. The hope and expectation is that they will begin here near term to notch down. We have favorable dynamic with oil and gas pricing, which does impact, obviously, the production of building products and the overall economy and consumer confidence. So we do believe that we're in a temporary situation where the affordability index is not in alignment with consumer confidence and incomes. But as we see deflation, as we see interest rates come down, and these other dynamics that I mentioned come in line with more historical averages, we do believe that we'll see a much stronger market going forward. And it's largely due to, again, the pent-up demand and just the fact the household formations are exceeding the supply. So as we the long-term investment thesis is well supported here. There's plenty of interest. There's plenty of capital. We're going to talk. Have a couple pages on the availability of capital here in a couple pages. But it's really not a question to most investors is if the market, if the sector is an attractive sector to invest in. It's a matter of when is the right time to get in. And one of the other things that I wanted to mention is that we're talking about some macroeconomic topics here. There's also some other metrics and other dynamics that I think are worth noting, and that's labor. To build homes, to do repair and remodeling, we need the labor to do so. And some very startling statistics that I'll just share. Currently, there's a deficit of 110,000 HVAC technicians from what's needed in the marketplace today. By 2027, there's expected to be a shortage of 550,000 plumbers. Electricians are retiring at about 10,000 a year, with only 7,000 entering the profession. You can think through or consider all the other professions as well. There's skilled trades of carpentry, roofing, tilers, painters, etc. They're all experiencing the similar dynamics. So even when the market turns, consumer confidence is in place, interest rates recede, we are still going to have to deal with a labor issue as it relates to closing the gap between supply and demand of new homes and repair and remodeling following the sale of existing homes, or those that stay in place, the repair and remodeling of their existing homes. So it is a very important consideration. I don't have a specific slide on it, but I did want to highlight that. So as we got deeper into the market and we got past COVID, we got past the downturn, the perfect storm that occurred in 2022, carried us all the way of 2023. We did see very positive signs as we were turning the corner on 2024, following a new administration in place in Washington, and very optimistic for 2025. And then what happened? Tariffs. So Tariffs, there was much talk about tariffs during the election cycle and leading up to the election in November. Um, there wasn't a lot of information around it as to what the impact might be. 2025 started out relatively strong from an M&A standpoint, performance of the businesses that we were working with, strong first quarters. And then again, we were faced with tariffs. And the impact of these tariffs is still being assessed, changes daily depending on which country you're thinking about. Some companies used the supply chain disruption that was surfaced during COVID to evaluate their supply chain, and thought through alternatives and executed on expanding their vendor base. So we saw a lot of our clients moving from China to supply base in Vietnam and elsewhere in Asia. We also saw a significant trend towards onshoring, so not relying on foreign suppliers to manufacture their products. Those that made those steps and changes to their supply base, they're benefiting from it now. Those that didn't are in a bit of a scramble. We obviously have meaningful date coming up here in July as it relates to Canada, one of our primary trade partners. That could be very impactful, depending on what decision is made there, positively or negatively, regarding building products and other industrial and economic impact from those discussions and conclusions of the negotiations. I don't want to spend a whole lot of time on tariffs because it is a moving target. There's some other areas I'd like to spend in the conversation. But the ultimate impact right now of tariffs has been just a general slowdown. And we think it's temporary. We think it's a near term. It is just a slowdown in M&A activity. From our perspective, deals are not being lost to tariffs. They're just being pushed out a bit as it relates to the timing for when they're ultimately brought to market. On page 15 here, I touched on this a bit, just what's been going on in the M&A markets as it relates to, actually, if you can go back one page, the volume of deals. In 2020, we did see a slowdown in M&A activity. Once we started seeing a reversal of fortunes, and building products was hot in 2021, we saw a significant rise in transactions, both by private equity firms and strategic buyers. So moving from 56 transactions in 2020 to 114 transactions in 2021. You'll see the interim period here between 2021 and year-to-date 2025. Not bad deal counts, but certainly not the highs of 2021, and not what our expectations were as we were turning the corner on 2023 and 2024. So where we are now, that's a year-to-date May number, 41 transactions. That's not a bad number. So if you annualize that, you're getting to close to 100 on an annualized basis for transactions in 2025. Our deal activity here at BGL would be supportive of that kind of number. Year to date, we've closed a couple of building products transactions. We expect to close another transaction next week and another building products transaction mid-July. So our expectation is that as a firm and my team here, we'll have a half a dozen or so building products transactions completed in 2025. So next page here, just a recap of kind of the history that we walk through here. Again, we'll see peak activity here that in kind of mid-year 2021. And then once we reached that peak, we breached into 2022, started to see a slowdown, and that continued for the balance of the year until we reached the trough in late 2023. And then as we turned into 2024, we started seeing an increase in activity. And then we got to 2025. And as I said earlier, we were expecting that trend line to continue up and to the right throughout the full year of 2025. And right now we're experiencing a tariff slowdown. But what led us to have great confidence, the next page, please, when we were looking at early 2024 and then again in early 2025, was that we saw some marquee deals being completed. And the common theme here were big names, big deals, attractive valuations. You'll see some of these multiples, $18 billion transaction between SRS and Home Depot at over $18 billion. You'll see the PGT and MITRE transaction, $3.1 billion deal, nearly 11 times. So when we were sitting there in early January in the first quarter, and we have these three marquee deals being announced in rapid fashion, we were expecting that level of activity to continue for the balance of the year. And there was a bit of a stall. And then again, we worked our way through 2024 and turned the corner into 2025. And then we see the AZAC transaction being announced in March, another large deal, $8.8 billion, a very high valuation at 22.5 times EBITDA. And then Beacon transaction, the Artisan Design transaction, all again falling in that category of big names, big deals, attractive valuations, but again, a short-lived trend. So, and again, in 2025, we attribute tariff discussions as the primary factors to the temporary slowdown here in 2025. So, next page, just more specifically around activity in the window and door sector, and this is a summary of January 2024 to January of 2025. You'll see here that there's 16 transactions that have been completed. Interestingly, 50% of the buyers here are private equity firms. 40% of the buyers represented here are public companies, and 10% were founder-owned or entrepreneurial-owned businesses. So there's a significant spread here in the size of the transactions. On the previous page, you saw the size of some of these transactions, but a very good set of transactions from a size standpoint and ownership standpoint as well. So window and door has been a darling of private equity and strategic buyers, and we expect that to continue. So on the next page here, I mentioned earlier around what gives us great optimism around M&A activity, and specifically M&A activity in and around building products. As I mentioned earlier, the laundry list of why we believe and others believe that there's a long-term investment thesis supporting an attractive investment profile in building products. Not only is that interest there, but it's also coupled with very significant amount of private equity dollars available to complete the transactions. So you'll see the trend lines here in what we refer to as the dry powder. So these are committed funds by investors held in the coffers of private equity firms who are on the hunt for quality companies. And you'll see a high watermark here at the end of 2024. There was over $1 trillion of equity available to invest in businesses. And importantly, that's just the equity side of the transaction. Frequently, private equity buyers match or exceed the amount of equity that they put in a transaction with debt. So $1 trillion worth of available equity would equates to $2 trillion or more in buying power and available capital to invest in U.S. based and North American based companies. Another interesting dynamic. Private equity is, again, been a long-term investor in building products and window and doors specifically, but they themselves have not found an attractive environment to seek liquidity events for the portfolio companies that they own. So if you look in the far right here, you'll see that 40% of the 150 companies owned by private equity have been owned for 5 years or more. And that is I wouldn't necessarily call it a historic high, but it is certainly at the high end of where we've seen over the last couple of decades. And what this ultimately means is that there are very few, if any, long-term holders within this private equity community holding these 150 companies. So eventually, all of these companies will be sold. And from our perspective and the conversations we're having with our key relationships in private equity, it's a very high percentage of these 150 companies that'll come to market here in 0 to 36 months. So that to us tells us that eventually there's going to be a significant amount of product, if you will, companies, opportunities that we'll be bringing to market that'll be coupled with founder-owned and entrepreneurially owned businesses, as well as divestitures of public companies as well. So this is certainly not the full subset or full set of opportunities that'll come to market. It's just a one segment or one subset of the total population of companies that have to be brought to market. So it does raise the question as to what is the appropriate timing to bring a company to market. Right now, we're advising our clients that it's time to get ready to bring a company to market, but not necessarily launch. We do think as we get deeper into 2025, it could be 30, 60, 90 days that many of the companies that we have prepped to go to market will ultimately launch. It does become a question or a consideration for owners of businesses, whether it's founder-owned, entrepreneurially owned, or private equity, as to, again, there's this long-term investment thesis, well supported, that building products have a long run. Capital is available today. It's a bit discerning capital in that they're fleeing to quality. So if your business is a underperformer, this is not the type of market that you should consider launching in. If you have a business that's market leading, strong margin profile, strong growth profile, exceptional management team, this is the market to launch because high quality companies are getting a lot of attention. They're getting very fair valuations for the businesses that they are. But then we're also seeing, because the supply and demand is out of whack, that there are many more buyers out there than there are sellers of companies. So again, when a high quality company is brought to market, it gets a lot of attention. We get fair values for the businesses for what they are, but then we're also frequently able to extract a scarcity premium as well. So we have a lot of conversations with founder-owned and entrepreneurially owned businesses as to how to think through timing. A consideration is, do you want to be a company that's early to market, that capitalizes on this the strong market for quality companies? Or do you want to wait until the 150 or so companies that private equity owns are brought to market and that supply and demand relationship starts to shift? And when it starts to shift, we do believe that there's going to still be attractive valuations available, but it becomes less and less likely that you're able to also garner the scarcity premium that I mentioned earlier. So If we look specifically, I thought this may be of interest. If you look specifically at some of the primary assets owned by private equity, very good lineup here. This is certainly not all of them. This is just representative of the companies that are out there and have private equity backed sponsors in the transactions. So we're familiar with the vast majority of these. There's only two or three that we don't have standing relationships with. So if we can answer any questions that you have about any of these companies or transactions, don't hesitate to reach out post webinar. I'm happy to engage in dialogue with you. So I'm doing a quick time check here, and I do want to save time for questions. There are the next page here. I just want to put this out in front of you. And this is what we refer to as the window and door valuation scorecard. So this is a tool that we started using as an internal kind of triage tool, if you will, to evaluate new opportunities as they came to us to potentially advise in the sale or capital raising for the business. And here again, I'd be happy to have conversations one-on-one or with a smaller group and work through what this valuation scorecard might ultimately mean for you and your business. But we're running short on time here. But again, the offer is open. Please reach out to me via phone or email, and would be happy to convene and talk through a scorecard as it relates to your specific business. I thought being an investment banker, I couldn't get through a full presentation without talking about where we are from a valuation standpoint. So these are rough parameters. These would be impacted by the previous page that we had here, the scorecard. The scorecard is what we use to ultimately develop a targeted valuation that we discuss with clients and potential clients across this spread here of you'll see 5 to 6.5 on the low end and 8 times plus on the high end. What I would share with you is the transactions that we're bringing to market and have brought to market here over the last 6 months are very high quality companies. They have a very compelling value add that they're bringing to the marketplace. They have a reason to be. They have strong management teams, have experienced strong growth. So the transactions that we're completing would be in the far right category of, call it 7.5 times to 8 times plus. So those are the remarks that I wanted to make today. I see that we have 10 minutes or so available to us. Happy to answer any questions from the group.
Thank you so much for that very informative presentation, Andrew. We do have a handful of questions, so let's go ahead and get started on those. All right. The first question is, what are the solutions for labor? Current immigration stance is going to make labor even more challenging.
Yeah, that's a great question. And frankly, I don't have an answer to it. I would say that one thing that we regularly speak with our clients about and the products that they're producing is ease of installation at the job site. So as everyone knows, it's extremely difficult to manage on-site labor. So if a substrate is being delivered coated versus needing to be put in place and coated on site, lightweighting. So maybe it's 2 tradesmen versus 3 or 4 to install the product. Maybe they're able to ship kits or sub-assembled kits that are being installed on site rather than individual pieces, parts, and components. So there is no quick fix to the labor issue. There's no easy answer to it. but similar to regular conversations that we have with our clients around ESG, we are having conversations around labor minimizing installation and application in the field. Another example is we're talking with coatings companies that are developing single coat coatings versus multiple coat coatings. So it cuts the labor down by at least 30, 40, 50%. So those are the types of things that we're seeing as being very important to help in addressing the labor issue. And there's a lot more to be worked out there. There's a lot more to be seen. But it's a great question. That's why I brought up, the labor dynamic earlier. It's something that I think all building products manufacturers need to really think about how to make their products more of a complete product as they ship it and it gets to the job site, and then ease of installation.
Are there 3 to 4 key indicators from the market we should be looking for if companies are thinking of going to market?
I would say, there are. A couple of those would include continuing to see marquee deals being announced, larger deals, big names at high valuations, in that those are great market indicators that those that are deep in the industry have the resources to do the micro and macro economic analyses. If the smart money's moving into the industry, that's a good telltale sign that it's time to move in as well, as smaller investors, smaller companies versus what these multi-billion-dollar transactions that have been announced. I do think that declining interest rates, declining inflation will also be key indicators that a turnaround in the market is around the corner, and it's time to really get aggressive in moving into the industry, buying into a situation prior to the euphoria settling into the market, and paying top dollar on EBITDA, higher EBITDAs and higher multiples.
Are you seeing innovative products driving growth? Are buyers interested in innovation?
We certainly do. And some of that innovation is around ESG and addressing some of the concerns around environmental impact. And some of those, again, coming back to labor, we're working with a company that has a commercial interior substrate that is also designed and patented to have relatively low labor content to getting it installed in place. So those are some of the primary product innovations that we're seeing, again, driven around ESG and labor savings.
Will the US be able to manufacture glass and steel in accordance with the demand for this product?
Um, to be seen, but we believe so. We believe that there's sufficient North American glass capacity to achieve the relatively near-term growth rates. Steel, we do believe that there is sufficient supply. We also see steel and aluminum as a substrate being used more and more in building products that alleviate some of the pressure on steel. But the supply chain I mentioned is the issues have been alleviated. They have not been eliminated. And where pricing goes on some of those input materials is also yet to be seen.
This next question looks like it has multiple parts.
Uh-oh.
If home building companies experience margin compression due to elevated incentives and stretched affordability, how does that affect supplier conversations? Are family-owned businesses more likely to experience margin compression due to a lack of economies of scale? What is the service offering between large companies and individual homeowners for founder-owned window and door companies?
I'll take I think it was the middle question first. No, we don't see a meaningful difference between margin compression on founder-owned or entrepreneurial businesses than larger businesses owned by private equity or even public companies. We actually find that many founder businesses are more creative and more nimble in and around their supply chain and in and around the relationships that they have with their customers, that they can have very frank and direct conversations. If a material price increases, they frequently have a relationship, longstanding relationship with their customers, and they just have a frank conversation around it. Look, my costs are moving on me. It's not something anything we're doing internally. I need some relief here in the form of a price increase. We also see that in founder-owned and entrepreneurial situation, a perfect example is we have a client that their product is manufactured out of a resin base, and they're very nimble in purchasing their resins, and they also have suppliers with some of the largest international suppliers of resins that the resin suppliers call them and say, look, we got a relatively small volume of material available. We need to get it off. We need to get it off the floor. Will you take it? And they're able to acquire that material at a discounted price because of the longstanding relationship, and because they're not a you know a $1 billion company using a lot of the resin. They can take on smaller volumes of, I wouldn't necessarily call it excess resin that's available in the system, but they're able to buy those smaller quantities, and one, strengthen their relationship with the supplier and buy the resins at attractive pricings. So it just comes back to we do think we don't think that founder-owned and entrepreneurial businesses are necessarily in a position of weakness as it relates to larger competitors and larger acquirers of the same materials that they're acquiring. It's just we just don't see that dynamic on a regular basis.
What other countries have a strong housing market right now?
So we do a fair amount of work in Canada, and we're finding that the Canadian market is showing some great strength and resiliency, particularly in the plains. If you get out to the East Coast and the West Coast, it's a bit more challenged. But if you stay in the plains region of Canada, they're experiencing immigration and household formation at a very different price points. The affordability index is significantly better in the plains than versus the East Coast, West Coast of Canada. So that market remains fairly strong. We're not active down in South America, so I don't have any deal experience there as it relates to an outlook and current state of home building and building products. And then within Europe, they're experiencing much of what we're experiencing here in the United States.
What role do trade shows and industry participation play in identifying new M&A targets?
Um, we view industry events and conferences as extremely important. One, we use as opportunities to understand changes in the industry. We attend many of the educational sessions at the conferences that we do go to. We use the conferences to meet with company ownership, and also walk the floor, see what products, what's new, and what's new in the market, and understand the competitive situation in certain areas of the market as well, and seeing how, again, we do a lot in window and door. We go out to the builder show. We'll visit 15 or 20 different window and door companies, and we'll talk with the owners about what they're seeing in their business, what they're seeing in their product portfolio, what are some of the enhancements to products that they're working on and bringing to market. So they're extremely valuable for us to kind of keep the pulse of the industry, and stay ahead of kind of the knowledge curve, if you will. So we're not surprised by any changes in the marketplace. And then also, again, keeping a keen eye on what's new and exciting that's coming to market that can change the dynamics of a certain product category within the building product space. And it's also great for building relationships. So many of our clients do come from introductions at conferences. So it's a very important part of our business, our marketing, and also knowledge development.
Absolutely. Well, we are at time, so thank you again for the wonderful presentation and all of your intel and expertise.
My pleasure. And as I mentioned earlier, I'm happy to convene with anyone that reaches out regarding the comments that we've shared today, deeper insights as to where we think the market is going, and also to speak specifically about your businesses and how they may be received in the marketplace.
Terrific. Well, again, thank you to everyone who's joined us and spending a bit of your afternoon with us. On screen are a couple of our upcoming webinars. So we hope to see you again soon at one of those two webinars online. And just a reminder, a recording of this presentation with handouts will be available on glass.org's webinars page, glass.org/webinars, by midday tomorrow, and you will receive an email letting you know when it's ready as well. So thank you very much. Have a great rest of the afternoon.